Well, the bond yields are up over 6% for a second trading session. In fact, since the last two trading sessions itself, the yields are up nearly over 20 odd bips, and the yield trajectory has moved upwards since the start of August itself. In fact, since the month of August, we've seen the yields rising over 30 bips. To know that the downward trajectory of the yield did start somewhere around April, wherein in April the yield did stand at nearly around 6.5%. It fell down to 5.7% by in the month of July itself, post RBI easing liquidity as well as huge amount of rate cuts coming in from Reserve Bank of India. In fact, post the recent monetary policy, we are seeing that the yields have gone up. Now, what has happened is the good amount of the rise in the yields, especially over the 6% mark, has happened since the Friday RBI MPC minutes. RBI in the MPC minutes did mention that they have already front-loaded rate cuts. In fact, rates have been cut nearly around 250 bips since February of 2019 and 115 bips since March of this year itself. And RBI said in the MPC minutes that rate cuts have been front-loaded, and it would now be a wait and a watch approach. They would be watching out for the incoming data to assess the macroeconomic situation. RBI also acknowledged that yes, there are upside risks to the inflation. Inflation trajectory is fairly uncertain, and that the economy is fairly weak in India as of now. And having said that, RBI mentioned that if you look at the inflation, we are seeing that the inflation has been rising over 6% mark since the last 3 to 4 consecutive months, and hence RBI has stated that they would be using a wait and a watch approach. In fact, very much on Friday itself, RBI signaled to traders that the bond yields may rise. RBI sold 30-year bond on Friday at a cutoff yield of 6.75% versus the market expectations of nearly around 6.65%. The debt sale, in fact, was post the RBI policy minutes. RBI offered higher borrowing cost at the debt sale, and this took the traders by surprise. Traders now really have to brace for higher borrowing cost going ahead, or rather a higher yield curve going ahead. And we also possibly need to wait and watch out for any other measures coming in from RBI in order to soothe the pressure in terms of the bond markets. Now, if you look at the entire explanation of why the yields have been rising, well, yields normally rise in the system when inflationary expectations are seen rising, which is now there in the current situation. One of the tools that RBI uses in order to control the inflationary expectations in the economy is to hike interest rates. RBI either pauses on the rate cut trajectory that it has already undertaken, or goes ahead and hikes the repo rate, signaling that the interest rates in the system are likely to rise from here on. If you look at RBI also normally eases the liquidity conditions in order to transmit the rate cuts, which RBI has already done. And hence, after the huge amount of easing that we have seen in terms of the liquidity, in terms of the rate cuts, we did see the interest rates in the system easing. Banks have transmitted a good amount of rate cuts, and liquidity also has improved. RBI also has front-loaded rate cuts. Now, in the current scenario, when the inflationary expectations are rising, as I explained that inflation has been up over the 6% mark, RBI does not want to go ahead and stoke further inflation by cutting rates, and hence RBI said that they would be using a wait and a watch approach. Higher inflation is also detrimental to the purchasing power of the consumers. In fact, we also understand that bond yields as well as bond prices do have an inverse relation. Bond prices fall when the yields rises, and hence we have seen that happening in the economy. What does higher bond yield really mean? Higher bond yield does mean higher interest rates for the consumers. The cost of borrowing for the consumers, be it for the home loans, for any other, say be it a personal loan or an auto loan, or even for corporates does go up when the interest rates are in an upward trajectory. But as of now, do note that RBI has only stated that possibly they would wait and use a wait and a watch approach. RBI has also mentioned that they do have the available monetary space in the current scenario, but they would want to use it fairly wisely in the given scenario wherein the country is dealing with the pandemic and most of the inflation rise is on account of supply side disruptions and India economic growth is weak. As such, quite a few of the economists do expect another 25 to 50 bips rate cut coming in from RBI for the rest of the fiscal.